Hello, I'm Mary Beth Ray, President and Chief Executive Officer of Fort Washington Investment Advisors. On November 11th, we held a live webinar featuring our Senior Economic Advisor, Nick Sargent, to recap the results of the 2020 presidential and congressional elections. With a long and successful career that has included prominent roles with the Federal Reserve Bank, the U.S. Treasury Department, Salomon Brothers, Prudential, J.P. Morgan, and of course Fort Washington, Nick has a unique and insightful perspective. At the end of his presentation, one of my colleagues from Fort Washington, Nick Reardon, who's responsible for developing our business with endowments and foundations, will join me in asking Nick Sargent to respond to a few of the questions we received from the audience. We hope you will find the presentation valuable, and thank you for joining us for this program.
Thank you very much, Mary Beth, and thank all of you for participating in our discussion today. So we've just finished a historic election. In my lifetime, it may be the most contentious that I can recall. And what we've learned from this is that the nation is still very divided in terms of rural versus urban voters, in terms of college versus non-college educated, in terms of geographic region, and even gender. So now, though, we do have the outcome, and what I want to do is discuss with you today, where do we go from here? And the particular focus that I'm going to be having is on what can we expect in the way of economic policies that we will be anticipating over the next 4 years, and what will be their impact on the economy and the markets. The backdrop is that 4 years ago, when Donald Trump pulled off the surprise victory, I gave a similar speech in Cincinnati and other parts of the country, and it was well received. And at that time, what I highlighted was that Trump's election, of course, was a surprise. He had no prior background in politics, so we knew that we were in for a different type of president than we had seen before. But what is especially important at that time is that in the election, the second surprise was that the Republican Party won control both of the Senate and the House. So you had one party in control of all the major branches of government. And my theme then was that this created the potential to see a game-changing election. The reason being that previously we had divided government. And I don't know if you recall all the government shutdowns we went through, and people were wondering, can't we ever get any legislation through in Congress? So this is what really made 2016 a special election. Well, coming to present day, one of the things before the election, the question that we faced was, we knew that Joe Biden was going to be the candidate of the Democratic Party, but many people were looking at polls and seeing that there seemed to be the potential for a so-called blue wave in which the Democrats could win now control of the Senate, as well as, it was believed, adding to the seats, well, the margin that they had in the House of Representatives. And considering that Joe Biden's central message on economic policy was that he wanted to reverse the Jobs Cut and Employment Act of 2017, which is considered the signature legislation of the Trump era. That's the legislation that had widespread cuts in corporate and personal income taxes. Again, the potential was, could we now see basically a complete reversal of policies that were enacted in the Trump era? Well, now that the election results are mostly known, the answer seems to be no, we did not get the blue wave. Right now, it appears that the Republicans may be able to maintain control of the Senate with two key races still open in Georgia. There are two runoffs that will take place in January. But if there's even just a split, it's clear that the Republicans would still have a slender margin in the Senate. And meantime, the Democrats' margin in the House of Representatives has shrunk a bit. So as people now are assessing the outcome of the election, I'd say that the knee-jerk response is, well, what it portends is, are we headed back for gridlock? And against this backdrop, what I'm going to be doing is examining economic policies and saying, well, here's what Biden and the Democrats were seeking to achieve. And the real question is going to be, what will they actually be able to legislate? Or if they can't legislate, what will they be able to enact through executive orders? So, if I turn to just a quick recap of Trump's economic policies, and this I took right out of my presentation 4 years ago. I did steal the line from the cult classic Clint Eastwood, The Good, the Bad, and the Ugly, just for humor. But basically, what my main message when I looked at the policies that I was trying to assess for the Trump administration, I'm not trying to make a normative judgment. Economists and people can debate forever what's good or what's not good. I was trying to be empirical and say, we're investors, what will be the impact of various economic policies on the financial markets? Because then at the end of the day, we'll know whether we made a good call or a bad call. So what I listed that I thought that the markets would like would be, first of all, the tax cuts, and especially the corporate tax cuts, because the marginal corporate tax rate at the time was 35%. And as we know, under the Trump administration, they brought it down to 21%, which was much more in line with other countries internationally. At the same time, the Trump administration was very much a proponent of deregulation. And so many investors looked at this and said, wow, the combination of corporate, personal tax cuts and deregulation would help to spur economic growth, and this would be good for corporate profits in the stock market. And I certainly bought on to that line of thinking. And as we'll see, I think it proved to be correct advice. The second issue, though, was that, well, wait a minute, if we're going to have big tax cuts, are those tax cuts going to pay for themselves? This was the assertion that the Republicans were making, and it reminded us of the Reagan tax cuts in the 1980s. Well, at that time, the tax cuts were highly effective in promoting growth, but they did lead to larger budget deficits. And so my call was that I thought that the federal budget deficit would be getting larger. And normally, one would expect that that would see some rise in bond yields. So we're going to see that call was half right, but half wrong. But finally, the third thing, maybe one of the more controversial, was that traditionally Republicans are free traders, but not Donald Trump. He's long believed that the U.S. was not competing on a fair playing field. And he was, even in his campaign, said that he would like to impose tariffs on foreign goods, especially those from China. And so one of the questions was, if we were to proceed with that, what impact would that have, again, on financial markets? And my argument was that I thought that it would add to volatility in the stock market, because first of all, a tariff is really a tax on imports, but also it was going to have an impact, if it didn't have one on the US economy, on potentially overseas economies. So that was the basis for the call. So if we look now at the track record, just investment results, what I've done is looked at the various asset classes, and I've picked 3 time periods. I picked the first term of the Obama administration is on the far left. In the middle is the second term of the Obama administration. And then the third is what I call the Trump era. And there I didn't measure it from the beginning of Trump assuming office. I measured it from the time of the election until this last election. So when we look at the results, what's the story? And so first of all, I'm going to focus on the results in the Trump era on the far right. And what you can see is these are annualized returns. So over 4 years, the S&P 500 up 14.25%, the Russell 2000 9.25%, NASDAQ and the tech stocks leading the way up 22.5%. So clearly an outstanding run during that period. What I would point out, though, is that really from the get-go of his election until the early part of 2018, you didn't even have a correction of 3% in the stock market. It was just up, up, and away. But the markets did turn more volatile in 2018 and 2019 when our trade war with China escalated. And that's why I feel that the call on the tariffs being a source of volatility was the correct call. Finally, though, looking at returns on the bond market, what you can see is, they were close to the second term of the Obama administration in terms of high yield, but somewhat better for investment grade credit and treasuries. The thing to take note of here, though, is that most of these positive returns really were generated in the last year and a half. And it's really when we saw significant declines in US bond yields, especially after the COVID pandemic hit and we worried about a recession, because then the Federal Reserve took interest rates to zero and bond yields plummeted, which was good for bond prices. So, the bottom line is that is, if you like, the outlier on my call. But the main point I want to make is look across to the Obama era, whether you want to look at the first term or second term. And the main point I would make, and I think this is important to keep in mind, over the last 12 years, where we've been through two of the worst crises in US history, the 2008 financial crisis and the coronavirus pandemic, we have seen some of the best investment returns on record. And so, irrespective of who was president, you sit here and say, what was the winning strategy? Basically, I would argue that the winning strategy was to overweight risk assets such as corporate stocks and corporate bonds relative to safe instruments such as US treasuries, cash, and the like. So that was the key empirical finding. So now, as we headed into the 2020 election, so this is before the election, if you said to me, when investors were trying to size up, if Biden was to come through and win the election as was widely forecast, what was the difference of his fiscal plan versus what we saw in the prior 4 years? And so on this chart, and by the way, the data that I'm showing you is taken from the University of Pennsylvania's Wharton econometric model. So I'm keying off of one of the best modeling groups in the country. And so what was the conclusion about the plan that Biden was putting forth? And I would say, in a nutshell, the plan called for significant increases in government spending over the coming decade, roughly $5.5 trillion. At the same time, significant increases in taxes, corporate, payroll, and personal. And they would total, they're estimated to be about just shy of $3.5 trillion. So this is why I say when you look at this plan, if enacted, you would say this is a sea change from what we were seeing in the Trump era. On the spending side too, and we're going to come back to this, what were the priorities? Number one, Biden wanted to put money into education, including tax-free tuition for people in community colleges and helping finance students from lower income families. He was also in favor of a major infrastructure program, including green energy, and then also on the healthcare front. I would say these were the main priority areas. One thing I do want to make clear, because in the campaign, of course, the Republicans were trying to paint Biden as being very beholden to the progressives, such as Bernie Sanders and Elizabeth Warren. Let me assure you, there is no doubt that there is no way that his program is anywhere near theirs. They would have expanded spending $30 to $50 trillion over a 10-year horizon. Okay, the second thing, though, to take note is on the corporate tax front. In Biden's case, he would boost the corporate tax rate from 21 to 28%. And the estimates of analysts are that this could maybe impact after-tax corporate profits, lower them for businesses anywhere 5 to 10%, so significant. On the personal tax cut side, where the biggest impact is not on lower and middle income families, but high income families earning a household income of more than $400,000 annually. And finally, one of the things that I don't show here is, in addition, his plan would call for raising the capital gains tax rate from 24% to 39.6%, and similarly for dividends. So clearly, if we went into this election and you had both Biden wins and the Democrats are in control of both houses of Congress, this was the biggest issue for the investors going ahead. What would it do to the market? Well, my answer is, at least for the time being, assuming the Republicans can retain control of the Senate, it's going to be very difficult for them to get through this ambitious program, either on the spending side and especially on the tax side. So one of the reasons that the stock market has rallied post of the election results is they say, oh, well, the good news is, what will we get? I think most people expect we'll get some boost in government spending to extend the provisions of the CARE Act. So we're going to tackle coronavirus spending, but probably not until after the inauguration. But the market says, well, at least that will help us stabilize the economy in this difficult period. If you said to me, though, on the spending side of all these initiatives, where do I see potential for some compromise? I would think, if I was Joe Biden and you want to reach across both sides of the aisle, you may say, why don't we see if we can find common ground with Republicans on the infrastructure side? Again, I don't think Republicans will go for the order of magnitude or necessarily the green energy strategy, but we may be able to achieve some compromise on that front. But beyond this, my basic conclusion is it's very difficult to know right now what other type of legislation we may be seeing. So in this sense, I think you can say one of the conclusions is gridlock is back after 4 years in which we had one party in control. So now, what will be the implications for the federal budget deficit and the debt of the federal government? And also, what impact is this likely to have on interest rates when we take into account how the Federal Reserve is setting monetary policy? So in this chart, what I wanted to show you is, what am I measuring? I'm not measuring the federal budget deficit. I'm measuring how much debt outstanding is there by the US government. So think of it, treasuries, agencies outstanding, that's held by the public. And how does that compare as a percent of the size of the economy as measured by GDP? So what the chart basically shows us is, in much of US history, it's averaged about 40% of GDP on average. And then along came the 2008 financial crisis. At that time, the worst in post-war period. And as we all know, there was massive government spending to try to get us out of the deep recession that the country was in. And so, heading into the past few years, we had seen then the federal debt rise to about 75 or 80% of GDP. And then this past year, along comes coronavirus. And once again, massive federal spending. The CARES Act alone was $2.25 trillion, and subsequent acts boosted federal spending by more than $3 trillion just to combat coronavirus. So where are we today? We have not seen this in post-war history. Basically, the debt outstanding is now equal to the size of the economy. So, many people are looking at this and saying, this can't keep going on. And my answer was, you're absolutely right. Over the long run, you can't pile up debt at this order of magnitude. Almost everybody agrees for that. The real question, though, is, but can it keep going on for a while longer? And my answer is yes. And so the question is, why? So one of the things I wanted to show you here is we discussed how much government spending had increased to fight the coronavirus, but now we're bringing in monetary policy in terms of what is the Federal Reserve doing and what is their takedown of US treasuries and agencies. So they're buying through their quantitative easing program, they're buying a lot of the debt of the federal government and its agencies. So what this chart shows you is, again, in the middle of the chart, prior to the 2008 financial crisis, the balance sheet, the assets of the Fed was in the vicinity of $800 billion, not overly large. Well, by the time we go through 3 or 4 rounds of quantitative easing, we were up, a few years back to the balance sheet being $4.5 trillion. Okay. And then the Fed thought, well, conditions are improving. They began to announce that they were going to allow some of their holdings of treasuries roll off. And that's where you can see the beginning of decline. And then wham, along comes COVID. And then what you see is, again, the balance sheet of the Federal Reserve growing from, say, $4.5 trillion to over $7 trillion. So let's say an expansion of about $3 trillion. So when you think of this, then why is it that the interest rates haven't gone up and in fact have come down? Part of the explanation is because we've had massive buying by the Federal Reserve. So if you like, in standard parlance, the Fed is monetizing a good chunk of the deficit of the federal government. So that's part of the story, but it's not the full story. The other part of the story that I want to say is, we all know, well, wait a minute, we all know from Latin America and a lot of other countries, wait a minute, if central banks monetize deficits, doesn't that lead to inflation? And the answer is, when we look at many countries, that is the answer. However, the US is in a different circumstance where, despite the massive increase in the Fed's balance sheet, what I'm trying to show you on this chart is 2 things. The 2 key drivers of bond yields are inflation expectations and then real yields, or yields ex inflation expectations. So if I focus on the left-hand side of the chart and you say, well, what's happened to inflation, say, in the last 2 decades? Keep in mind, the Federal Reserve has been targeting for core CPI inflation an average rate of 2%. If you look at this chart, what you see is the problem hasn't been that inflation's been too high. The problem has been that the Fed has not been able to attain its target of 2% for quite some time. And, we can go through a lot of explanations. I won't go through details, but one of the important reasons, in my view, is that even though when the Fed buys treasuries, it expands reserves that the banks have, that only enters the money supply if the banks then take those reserves and make new loans. And so what we haven't seen until very recently is that banks using those excess reserves to make new loans. They've been sitting, if you like, on a hoard of cash. And the reason is they now are being paid to hold interest on their reserves. So the bottom line is the Fed says, we think that this situation is, we want to get back to normalcy, and we want, to see if we can hit our 2% target of inflation. So in September, they basically announced that now they're aiming for 2%, not in every individual year, but over an average period of time. So let's say this year, inflation comes in at 1.7. The Fed says, well, we can afford to have inflation go above 2% over a period of time. So the bottom line, though, I still would say is one reason bond yields are so low is inflation expectations are. The second reason that bond yields are so low is that even if I strip out inflation expectations and I just look at, well, what are bond yields, treasury yields giving me? And I'm measuring them by TIPS, Treasury Inflation Protected Securities. What do you see on this chart? Historically, for me, Treasury real yields have been in the vicinity, even if I go before this period, 2% or 3%. Well, of late, they got down to less than 1%. And then when coronavirus hit, yields now are minus 1%. Think of that, minus 1%. So you're basically paying for the privilege of holding these instruments. So the bottom line is people ask, can we see bond yields rise anytime soon? And the interesting development, and it's just a development this week, is we've started to see these yields begin to rise. And you say, well, why? And I believe that the key reason was when we got the announcement of Pfizer perhaps having an effective vaccine for handling coronavirus. Investors now say, wait a minute, maybe this means that the economy, which is recovering, maybe recovery can even be stronger than we thought previously. And so you start to see a natural rise in interest rates as people think economic conditions are improving. So bottom line is the budget deficit is out of control long term, but near term, interest rates to stay low. But if the economy improves, you've got to anticipate that there will be some uptick in interest rates in the coming year. Now, let's turn to trade policy. And again, what was unique about Trump is he's a Republican. Historically, Republicans have always been believers in free trade. It's been the Democrats who historically say, well, we got to protect American workers. And that's why Democrats have often been in favor of tariffs so that we face less competition from abroad. Well, Donald Trump understood that. And one of the reasons he was able to win the election 4 years ago is he basically won over a lot of blue collar votes by saying, we've not been playing the game fairly. China has taken advantage of us. And this was the principal reason then that he said, I've got to put pressure on them to open up their markets. And one of the ways is to implement basically tariffs of 25%, more or less across the board. His hope too was that in the process, that it would make it more, make US manufacturing easier to compete. It would bring back jobs. So what's been the verdict? I would say the verdict is we still haven't seen an increase in manufacturing. We might have seen a little bit until coronavirus hit. So I would say, many people would say that the goals of the tariffs have not yet been fully achieved. And even though our trade deficit with China has shrunk, our trade imbalance with other economies in Asia has actually increased. That's why the overall trade deficit hasn't shrunk. So the bottom line is, what's Joe Biden going to do about this? And what I find interesting, and again, here he doesn't need Congress. This can all be done by executive order, is that Biden so far has not tipped his hand that he's going to take the tariffs off of China. And my attitude is, why should he? Trump did the heavy lifting for him, so he doesn't need to do anything. What I do believe he'll do is twofold. One, Trump was in favor of bilateral negotiations. Biden is old school, multilateral negotiations, World Trade Organization, et cetera. He wants to form a coalition with our traditional allies to put pressure on the Chinese. So my bottom line when I come to trade policy is it was a source of volatility, especially in 2018, 2019. I don't think it's going to be a source of nearly as much volatility going forward. So now let me turn to what's new that we didn't talk about 4 years ago. And this is, what are we going to do about COVID? And many people would argue that this might have been the issue that in the end swung the election in Biden's favor. When I've looked at exit polling, not by wide margins, but by narrow margins, basically Biden got the nod for handling COVID better than Trump. Trump got the nod for handling the economy better than Biden. That was, if you like, how voters were looking at the two candidates. So what was the difference in their stance? I would say, Donald Trump at first, was caught off by surprise like everybody else. What are we going to do about it? And basically, at first for a while, he did listen to his health advisors, Fauci, Birx, et cetera. When things really got bad in March and the cases were spiking, they convinced him, Mr. President, if we don't do anything, you're going to see potentially 2 million dead Americans. Okay, that was enough to say, all right, we'll go along with shut down businesses and schools. And we did so more at the state level than at the federal level. Okay, but I would say by April, Trump realizes, my God, this economy is seeing even a quicker nosedive than what we saw in the 2008 financial crisis. And I can't let this happen on my watch. And so basically, Trump began to argue in favor of reopening businesses and schools and the like. And so, his signature statement is the cure cannot be worse than the problem. So what was the difference with Joe Biden? Joe Biden would say, look, the president's accusing me of hiding in my bunker and I'm going to shut down everything. That's not my intention. My real message is, though, if we want a recovery, our ability to have a sustained recovery, we've got to bring the pandemic under control. And so I think, again, one of the first task forces that Biden's announced is the task force to advise him on how to deal with the pandemic. What are we anticipating? Obviously, more clear statements at the federal level about masks, social distancing, social, a contract tracing, and then, so basically, I think that the approach would be more at a federal level than at a state level, but it remains to be seen. So lastly, then we talk about COVID and what is its impact on the economy? How do we feel about it? So let me first begin by saying I was very worried when it hit, like a lot of people. And as I look back, I think the good news is the recovery has been quicker and more robust than I thought. And I'm happy to tell you that. What's the worry? The worry is we're now entering the winter months and the number of cases and the number of hospitalizations are back to record highs. And when we look across the pond in Europe, we're seeing here we thought they had it under control. And now their situation is as dire, if not more dire, than our own. So I think that, therefore, the big uncertainty to me is how we get through the winter months. And I've got to be prepared that the pace of recovery could certainly slow down. If we're not going to have a broad scale shutdown, but we could have targeted shutdowns. Lastly, though, what's the ray of hope? And I already mentioned it, Here, the announcement of Pfizer, we have Lilly on vaccines and others. I think now there is basis for optimism that we could have vaccines, listening to Fauci, maybe on a widespread scale as early as next spring. So that's got to be somewhat reassuring to us. So again, I think we're in for a tough spell, but I do believe there's light at the end of the tunnel. So finally, let me wrap up with the economy and the markets and what I think is the most important takeaways for you. So far, my talk has been focusing on the impact of economic policies coming out of the election. But keep in mind that especially if we have a situation of gridlock, the policy changes aren't going to be as dramatic as if you had one party in control. So therefore, really, what you want to do as an investor, in large part, comes down to what you think the economy is going to be doing in the next few years. And what I've tried to do here is, because in politics, everybody can make assertions. What I'm just showing you is, I'm Joe Friday, for those of you who remember, are old enough to remember Dragnet, just the facts, ma'am. All I'm showing you on the first chart is the growth of the economy in the last 10 years, real GDP growth measured on a year-over-year basis. And forget the COVID period for the time being, where you get the big dip. If you looked from 2010 to 2019, and I said to you, what does this chart show you? Do you see a major change in trend? I don't. I see a trend rate of growth somewhere in the low twos, say 2.25, 2.5, with variations about the trend. And even in the Trump period, we had one year where we came close to getting 3% growth, but even pre-COVID, the average was about 2.5%. So my bottom line is, politicians like to take credit, and they don't like to take blame when things go wrong. My bottom line is, irrespective of who was president, the economy was the Energizer bunny, growing at, not spectacular, but a steady pace of 2.25%, 2.5%. And if you ask me, where are we going to be? I think next year we get back close to that trend rate. The second chart that I want to show you is, well, what about jobs? And again, people can look at this, well, who did a better job of creating jobs? I look at this chart. This is total non-farm payroll employment over the last 20 years. And so again, we had two dips, 2008 financial crisis and the COVID pandemic. But if you take, again, the expansion period, mid-2009 till the end of 2019, what do you see? I see a steady rise in new jobs. And again, independent of who was sitting in the White House. Trump might be able to say, yeah, but he had a tougher act to follow because jobs creation, in his instance, came late in the cycle. It's always easier to create jobs earlier in the cycle or mid-cycle than late cycle. I think that's fair enough. But my main point, again, is my theme is the resilience of American workers and businesses to overcome two of the worst crises that we'd seen in post-war history. So lastly, what is the conclusions of all of this? So you have the elections, and before the results were out, I can't tell you how many publications I read telling me what to do as a result of the election. My honest advice to you is, it's okay, throw most of them in the waste paper basket. And the reason I say this isn't, people were making good calls, but many people were assuming that there was going to be one party, the Democrats, calling the shots on everything. And the bottom line is that hasn't happened. So, in summary, what I'd say is, what about Biden's victory? I think I changed the word. The narrow victories actually will win the popular vote by about 5 million. His margin is bigger than Hillary won. And ironically, Biden's electoral vote tally, if he picks up Arizona, which is looking very close, in Georgia, it will be exactly the same that Donald Trump had, 306 votes. But I would say it wasn't his narrow victory. I'd say it's that the victory is contentious, means it's harder for him to say, I have a clear mandate to govern both sides. The second thing is, again, depending on the outcome of the races in Georgia, the Republicans probably still have control of the Senate. 3, expect budget deficits to remain large, but expect the Fed to continue to provide the support. So rises in yields are not going to be huge. If the economy does better, they'll pick up. I don't see the tensions with China being as great as they had. So I don't expect that to be the source of volatility. And then again, lastly, the biggest risk, people say to me, what's the biggest risk for the market? I'd still say in the near term, it's how bad this second wave of COVID is going to be in the United States in terms of hospitalizations and in terms of how much do we see in the way of partial shutdowns. But if you go to me and you say, Nick, looking beyond that, are you basically upbeat or pessimistic? I would say, again, I am impressed by the resilience of the US economy. And that's one of the reasons where, in terms of our investment strategy, we haven't changed our asset allocations. We entered the elections with overweights, moderate in risk assets, meaning favoring stocks over bonds, and within bond portfolios, favoring corporate mortgage-backed debt over US Treasuries. And we're sticking with those strategies because we don't see this election as a game changer. With that, I'm happy to turn over to any questions you may have. Thank you.
Okay. Nick, thank you so much. As usual, you have a wonderful way of what we say, making sense out of what so many of us see as just simply chaos. So we really appreciate it. While Nick was speaking, we did receive a number of great questions from all of you. So we're going to jump right in and see how many we can answer. So the first question is, will a doubling of the marginal tax rate on capital gains and dividends disincentivize investors? And secondarily, could it also force investors to take more risk in their portfolios?
Okay, well, this is a question that if I thought we had, let's say the Democrats do pull an upset and win both Senate seats in Georgia. So then we could go and say, maybe their idea to raise taxes is back on the agenda. Mary Beth, the way I would respond is, if you increase, the tax on dividends or capital gains, it creates incentives for you not to hold as much equity in your portfolio. I don't think it says to you, oh, now that the after-tax return is less than I thought, now I've got to take more risk elsewhere. So I'm not worried about that. What I thought at the time, though, was let's say that you thought before the year is out that they're going to raise the capital gains tax rate next year from 24 to 39.6, and same for dividends. What's a rational investor going to do? What would I tell clients? And what would I tell myself? And I'm saying, I've had some stocks that have had a good run and I'm sitting on big profits. Guess what? I'm going to use this as a period to take capital gains on those stocks. So I thought initially, if we had this, that the stock market, we might see year-end selling in the stock market. That's the knee-jerk response. But even then, if you said to me, okay, now you've done that, now the calendar's rolled over to next year, what are you going to do? I would say bygones are bygones. You've made a smart move to reduce your potential tax hit, but you've now raised more cash. So what are you going to do? And I think then, then you got to say, okay, now where do I put the cash that I've raised to work? And so what I would say is I wouldn't have been surprised then people sold, but then bought back, in the beginning of the new year. And again, though, the calculation that they're making is, gee, my after-tax return on the stocks that I buy going forward aren't going to be as high because of these taxes. But you know what? I got to beat cash or I got to beat bonds, and just the rates are so low. So my take is that if it had happened, I would have been prepared for year-end tax loss selling, but then maybe see a bounce in the coming year. And again, my main message, I think, to the investors is ultimately make your decision based on whether you think the economy is going to be improving or not. I think that's the better way to make the decision.
Okay, Nick, thank you. Our second question asks, with the vaccine coming and more stimulus on the way, doesn't that set the stage for a good time to invest?
Okay, certainly all of us are asking that question right now. So let me give you how I think about that. If you said to me, when I was when I was writing risks to the stock market, say from the middle of the year on, I basically said in the middle of the year, look, the market has largely been ignoring the election because it's too early. But as we get closer to the election, market's going to have to pay some attention, especially if there's a blue wave. And then if you really said, hey, Nick, the economy's doing better than you told us it would, don't you agree? My answer would be, you're absolutely right. It's doing better than I thought. But if you said, so what holds you back? I would say, I'm still worried about a second wave because everybody else was telling me that COVID was going to go away in the summer with the warm weather. And as we all know, that didn't happen. We did get, some would argue we got a wave then. But I've been worried about the next COVID wave, again, not leading to across the board shutdowns, but slowing the pace of recovery. Those are my two risks. So now I look at the market now and say, my one risk about the Democrats raising taxes, I don't have to worry about that. That makes me feel better. So that's a plus. And my second risk on COVID is panning out. But the thing I've just learned that I didn't know is we actually could have a vaccine that might have widespread distribution. Nobody knows exactly the date, but maybe by the second quarter of next year. That tells me again that there is hope. So my bottom line is, here's what I think I would say. For people who are heavily into equities, you made your bet. Hey, congratulations, hang on. For people who were sitting on mounds of cash, fearful of either of these two outcomes, I would say, I think it's okay over a period to begin redeploying assets. And that's probably what I'm going to do for Nick Sargent.
That's great, Nick. Hey, and one last question. If Republicans win control of the Senate and Biden is president, what specific sectors are likely to benefit when we come into the new year?
So basically, Republicans retain control, but so then, Mary Beth, that's my gridlock scenario. So what I would do is, go back to the chart I had on Biden's fiscal plan. Before, when people were thinking blue wave, what did you have? Well, you had people saying, oh, well, he's going to favor renewable energy, et cetera. We're going to take a bet on that. Or, maybe healthcare, he's going to come up with a slight modification of healthcare or education, et cetera. So I was seeing, again, people creating, these were, investment firms that market, they were creating Biden baskets, if you like. So what I'm basically saying is those are the reports, throw in the trash bin, because lot of what he was calling for, I don't think materializes. So the ones, that when I really tried to sit here and say, again, where did I think that there was the most likelihood of getting a compromise so Biden and Mitch McConnell can make a deal? I think it'd probably be somewhere in the infrastructure area. But the tricky part there is the Republican idea of infrastructure and the Democratic idea of infrastructure is going to be somewhat different. So my bottom line at the end of the day is, I don't. If I had to just come down the bottom line, I don't see huge sector bets because of the divided government. But I think there could be, some things where at the margin might make a difference. And I think, quite honestly, Mary Beth, it's so early right now that we haven't even seen the horse trading begin. So as we get more information, I think we'll have a better idea of what might be potential winners and losers.
Thank you, Nick, and thanks to all of you for your wonderful questions. I know we didn't get a chance to answer all of them, but I certainly hope that we can follow up with each and every one of you and continue this good conversation.